look, Goldman Sachs are the big boys on Wall Street. Whatever, whenever, wherever Goldman Sachs says something, I listen. Okay, they are the big boys of Wall Street. They're rarely wrong, and so one of their analysts was kind of agreeing with me. So I'm just going to put that up as well. Talk a little bit about what Goldman Sachs is thinking, and I do understand. By the way, so there's a seasonality in the stock market. Okay, so we all know, I'm actually putting up a video this week about stock buybacks. So companies are buying back their shares. You want to call that hocus pocus accounting, fuzzy math, whatever it is what it is. There is $1.6 trillion worth of stock that's going to be bought back this year by all companies. Okay, that includes your Googles and Apples, and they're constantly buying back stock. So that's putting a floor under the market. That's one, but that's done throughout the year. But most of it is done in the first quarter. What else is happening in the first quarter? 401k allocations are coming into first quarter. Okay, all that money is going into the market. So seasonally, the first quarter is very, very strong for the markets. Okay, well, especially the first month and a half or so. And what else is going in? Well, we have $7 trillion sitting in money markets, which is being, applied to purchase stocks. That's another thing that's going on. And last but not least, when importantly, we have to understand, as I said, more buyers than sellers, more demand for stocks. Well, okay. So seasonality, first 6-8 weeks of the year is very, very strong. And then we get into, watch out April, May, June periods. And then, summer rally happens if it does, because not too many people are around. But this Goldman Sachs analyst was talking about the same thing I was talking about. This is actually yesterday. Today is the 14th. This came out yesterday. Retail investors bought the dip after hot CPI. For sure they did. This Goldman strategist says the tide is about to turn, and they put a picture of everybody being in the pool, as you guys can see. And I agree with this. Seasonality is on the side of the market, okay? There's tons of money coming in. There's stock buybacks happening continuously, but that's something throughout the year. But then when the 401k contributions are invested, when the IRA contributions are done, and people do it usually before the tax season. And what's going to happen when everybody's in the pool? See all these people in the pool? Okay. When everybody's in the pool, what happens? Nobody else is left to get in the pool. And that's when the rug pull usually happens. Again, I'm not saying it's going to happen tomorrow or next week, but I do see definitely increased volatility. If nothing else, there's going to be a few rug pulls this year, and hopefully you'll survive and you'll watch the channel, and I'll be able to guide you correctly. But I do agree with Goldman Sachs on this one. Goldman Sachs, they may be a little early, like I am, but I think when everybody's in the pool, you got to watch yourself. You got to be really, really careful. And how do you be careful? Okay, so yeah, stocks go up. We have a saying in the market: stocks go up the stairs and take the express elevator down. We do know that's the case. It's been the case in the history of the markets. Okay, so when the rug pull happens, what do you do? Okay, how do you protect yourself? There's many ways to protect yourself if you are a trader. If you're a long-term investor, you don't have to do much. You just weather the storm, wait for the dip. If you have cash available, dollar cost averaging every month, whatever you're doing is fine. But if you're a trader, and then you got to watch out. So how do you protect yourself from a rug pull? Well, many different ways. You can short, right? Obviously. That's something that's really counterintuitive to a lot of people, but I can short as fast as I can buy a stock and sell a stock. You can protect yourself by hedging, by buying puts and indexes, or buying puts on individual stocks, or by selling calls. There's many, 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 many different ways of protecting yourself. And when you do that, your downside risks are going to be minimized. Is it going to eliminate the downside risk? No. But for us, the important thing is not to make it, is for us, the preservation of capital, how to keep it, how to keep most of it. And then if you're a trader, it's easy to make it. When the markets are hot like this, you throw a dart, you make money. And but when things are getting difficult, when things are selling off, like we have a couple of stocks today that are down 50%, that was on my watch list. And so what happens is that you need to learn how to properly hedge yourself. Okay, and And can you make money on the downside? Of course you can. I mean, I usually make money faster on the downside than I make on the upside. But you need to be prepared. You need to have your strategies lined up. You need to have your playbook lined up. And when you do see the trouble, you act on it. Just like, stocks go up and stocks go down. Indexes go up, indexes go down. You don't have to be a jockey that trades something every day. Day trading, I don't do. But if you're a swing trader or a position trader, certainly you need to look into how to hedge yourself and how to minimize risk. And there are many tools. You can do it through the futures. You can do it through options. You can do it many, many, many different ways. And, so I'm just saying that be on the lookout for a couple of rug pulls this year. It'll probably quick ones. I think macro is still hanging in there to a reasonable degree. So I'm not worried about a massive bear market or something like that, but there will be some rug pulls because as we saw in that picture, everybody is in the pool.